Welcome to the B.F. Anderson Technical Report for August the 19th. Look at the size of that footprint. That's an institutional investor compared to you. Institutional investors control the market. They control 80 to 90% of the ownership and the volume of the 8,000 publicly traded companies out there. So you really need to pay attention to what they're doing and what they're paying attention to. If you'd ever like to discuss that with me, let me know, but there are definitely ways to do that. Then on the upcoming week, I just want to remind everybody, not this Thursday, but next Thursday, a week from Thursday, the Fed is going to be meeting at Jackson Hole. We could hear some information that could be quite important. Now let's just get into the market. Nasdaq moving sideways, kind of breaking down. In fact, yesterday we got a violation here, which was where we closed below the 10-day, made a low, and then we actually broke that low. So far we're holding, but time to be cautious. On a long-term basis, we're fine. I mean, everything looks very positive here. We're above the 35-week moving average, very positive. Now, on the mid-caps, you can see the same old problem. We're basically moving sideways, actually broke down. We actually closed below the 10-day, holding the 50-day. Mid-caps are questionable. New York Stock Exchange, same kind of thing. We rallied up, made a new high, quickly pulled back into the base, somewhat of a failed rally. Small caps continuing to have problems. You know, if you look at the small caps over a long-term basis, they've been having trouble for a while. Now, I don't know what's going to cause this to change, but right now the small cap stocks are definitely the weakest group, and they've been the weakest group for a pretty good while. Here's the S&P 500. Now, here's the strongest index. There's no question about it. I mean, it's in an uptrend. You know, people that are involved in index funds that use the S&P 500 are doing perfectly fine. But I'm just of the opinion that if the market decides to crack, it's going to pull the S&P down with it. Now, on the long-term basis, we're fine on the S&P above the 35-week moving average. Now, on the aggression index, we're seeing, somewhat of a troubling situation here. We've got the Nasdaq compared to consumer staples. In other words, technology compared to toothpaste. So the reason this is important is that institutional investors, that large footprint, sometimes will start moving their portfolios into more defensive type stocks if they're worried about corporate earnings. So as you can see here, we peaked back on February the 10th. Came down, actually broke the 40-week moving average, but held, rallied, but failed to make a higher high. Now we're pulling back again and very close to breaking below that 40-week moving average, which would be a sell signal on this indicator. Now, on the three economic indicators, interest rates continue to vacillate around the 200-day moving average. We call this porosity, back and forth like porous. But very, very low interest rates. We're not seeing any dramatic change there. Price of oil, though, has definitely kind of somewhat moved into a downtrend. Now, on the financial stocks, somewhat of a sideways movement, a little bit of a breakout. But as interest rates continue to vacillate, so will the financial stocks. Not much going on there. New lows, somewhat troubling. We're seeing 100 new lows as of Tuesday. And, when we start getting over 40 a day on a regular basis, it's time to be a little concerned. Now, on the yield curve inversion, no inversion. However, we continue to move the wrong direction, which is because interest rates are moving down. But so far, so good. On the sentiment index, we're still neutral. On the AAII index, on the put-call ratio, we continue to be in greed, not seeing much improvement there. On the Russell 2000 Growth ETF, which is called the IWO, we see here the peak on February the 10th, big drop, moving sideways, another drop, another leg down, continuing to move sideways, came back and tested the 200-day, now is breaking below the 200-day. It's just simply saying that especially the small cap growth stocks, it's just not happening. Here's junk bonds compared to Treasury bonds. In other words, this is a ratio where I'm comparing junk bonds to traditional Treasury bonds. When the junk bonds are underperforming Treasuries, it's telling you that the market is worried about economics. So you can see here that we've been in somewhat of a downtrend. After being an extensive uptrend, we've now rolled over, broken the 200-day, rallied somewhat, holding a little bit higher high, rallied, made a higher high. Now we're making a higher low. So this is a good trend, but I'm saying the fact that it's breaking the 200-day moving average after such a robust period, it's reason for concern. Volatility index, market stays calm and quiet. So the volatility index is in good shape. Now, I want to talk a little bit about buy and hold. I'm going back here to 2007 through 2009. The S&P 500 lost 55.19% during that decline. In other words, $1 million shrank to $448,000. So when people start telling me about indexing or buy and hold strategies, I would really like to talk to them around March of 2009 to see how they feel about that. I would be very uncomfortable. It's just something to be aware of. Now, I did want to note, on the aggression index, we're comparing consumer staples, but this is the XLP, which is the consumer staples sector. You can see here it's definitely kind of working into an uptrend. These are defensive stocks. These are not aggressive stocks. This is Campbell Soup. This is Procter & Gamble. Those stocks, when they start to outperform, are somewhat of a warning, in my opinion. Now, let's get into the top 5. We're seeing some action in the steel stocks. Here we have Nucor, big gap up on heavy volume, nice move, rallied, is continuing to hold above the gap. This is a very positive pattern. Here's Lending Club, which is interest rate sensitive. Again, you're seeing a gap up, somewhat of an uptrend, and continues to hold the gap. Looks positive. Here's Alcoa, another steel or aluminum. Okay, you can see here that we're in an uptrend. We got a gap up, and we're pretty much holding that gap, but barely. I would watch Alcoa. Asana, which is software, mainly enterprise software, continues to be in an uptrend. Got a nice little pop here in earnings recently, which gave you this little bit of a buy signal, however, somewhat moving sideways. So that's it. If you have any questions, let me know. Thank you very much.